Good evening, ladies and gentlemen. This is Barry Norman on behalf of ETX, and welcome to our class on what type of trading is best for you. Now, please keep in mind we have used the word trading, not investing, because there's a big difference between the two. And if we were talking about investing, we would go on for hours and hours and hours. When we talk about trading, we're talking about trading, especially the types of trading that are available on our platform. Now, ETX is a regulated provider, and therefore I'm required to give you a risk warning. So let me read that and get it out of the way. Trading in the financial markets can result in the loss of the amount invested. Do not trade with funds that you cannot afford to lose, and seek advice if you do not understand the risks. All information provided in this webinar is for educational purposes only. ETX Capital and the presenter are not financial or investment advisors, and we do not recommend any securities or instruments. Any securities or instruments we talk about tonight are for educational purposes only. And for those of you that are joining us through the internet tonight, and don't know much about ETX, we are a fast-growing financial services company, and we are based in London. You can come by our offices and visit us whenever you like. We are authorized and regulated by the FCA, the Financial Conduct Authority, and we are also a member firm of the London Stock Exchange. We offer on our platform many different types of platforms that you can use to trade. You can trade binary options on our binary options platform. You can trade stocks, commodities, futures, and CFDs on our MT4 platform or our web trader. You can also, if you're based in London, trade spread betting on our platform. Excuse me, for somebody who just wrote in and said the sound keeps fading in and out, it's your computer and your internet, so I would advise you to sign out and sign back in again. Thank you very much. Okay, so tonight we're going to start off talking about the least simple or least complicated type of trading that you can trade on our platform, and that is binary options. Now, binary options are a simple and transparent investment instrument for clients to trade different asset classes such as currencies, stocks, and commodities. In a binary options trade, the payout is predetermined and set at a fixed amount. Binary options are like vanilla options in that they either expire in the money or out of the money. They were initially traded strictly between institutional investors, but in 2008 they were listed by the Chicago Board of Options Exchange, opening them as an instrument for retail brokers. Binary options is now one of the fastest growing investment products in the world. We believe that the growth of this asset class stems from the fact that potential gains and losses in a binary options trade are fully transparent prior to your investment. In other words, before you click the invest button, you know exactly what your profit and loss will be. Binary options has no leverage and no margin. They pay a specific return if you are correct, and you're only being asked when you trade binary options whether an asset will go up or down, not how far it's going to go. As long as it goes in the direction you selected, you will get paid the profit that is predetermined. If you are incorrect, you will lose the amount that you invested. So if you type in 26 pounds, you will lose 26 pounds if you're wrong. If you're right, and the asset, most binary options trade between 80 and 100%, and it tells you right on the screen before you ever make your trade what that asset will be paying. And if it says 80% and you invest 50 pounds, you will then get back what? 80% of 50 pounds or 40 pounds plus your investment. If you lose your investment, you will only lose the 50 pounds. So it's a very straightforward investment. Now, you hear lots of good things and bad things about binary options. First of all, that is based on the provider. Okay. When you trade, you should always be trading with a regulated provider. So when dealing with binary options, ETX Capital strongly believes that regulation is essential to ensure transparency, fairness, and safety for all those involved in binary options. To this end, ETX Capital is dedicated to ensuring compliance is met on all levels. Now, The advantages to binary options is they allow you to use your intuitive nature while you learn how the markets move. They are a great stepping stone to allow you to enter the financial markets while you want to learn before you go trade Forex or contracts for different CFDs, where you're using leverage and margin and the risks are high and the type of trade can be very complicated. So when you enter the world of binary options, you are entering the live global markets. Binary options are one of those things that if you know how to do internet shopping, you understand how to find information with Google or a search engine, you know how to use a computer fairly well, and you're comfortable doing things like online banking, you will be perfectly fine. With binary options, you only make 4 decisions, and all of these decisions are made before you invest 1 penny. You simply fill in the boxes. You start out by picking the asset. Now, on the ETX platform, you can choose from commodity stocks, indices, and commodity stocks, indices, and currencies. Then you just simply determine whether the asset will go up or down from its current offered price. You decide when you think this will happen, the time frame in which you want it to happen, and then lastly, how much you want to invest. So imagine binary options like renting or leasing an asset for a period of time. You have limited risk and limited responsibility, and all of your decisions are made up front. So when you come across an asset, you have different choices to make. The choices are how you're going to trade it, not which direction, but what type of risk and profit potentials you want. So to give you an example, you're walking down the street and you pass a gold coin dealership. In the window is this beautiful gold coin. You walk in, you say to this man, I'd like to purchase this gold coin. He says to you, it's not a historical coin. It is not a collector's coin. It is 1 ounce of gold. And gold today is trading at $1,250 an ounce. So if you give me $1,250, then you can have the coin. The man says, great, gives you his credit card. You charge him $1,250. He takes the gold coin from you. This is ownership. Okay. Everybody should own some assets. All of your portfolio should be broken down to assets you own, investment, short-term, long-term, medium-term. This is an asset you own. You paid for it, you own it. You put it in your pocket, you carry it around because you decide you want to make it your good luck charm. Now, you can put it in your safe deposit box, put it on your mattress, carry it in your pocket, you can give it to your grandchildren, you can borrow against it, or you can take it back to a coin dealer to sell down the road. But if you lose it, you lost it. You got to protect it. It's not going up and down in value, but if it falls through a hole in your pocket, you lost it. It's an asset you own. Now, since you bought it as your good luck piece, for the next year, things have gone really well. Everybody in the family is doing well. Everybody's healthy. You feel well. Your business is doing very well. So the gold coin, you think, brought you lots of good luck. It served its purpose. But because it's always nice to know what your assets are worth, when you come home from work each night, when you're looking at the financial news online, you see what the price of gold is. And you see it went up to $1,260, it went down to $1,190, it went back to $1,270, it went down to $1,175, it went back up to $1,292. But it makes you feel good when that little thing in your pocket's worth a few bucks more than you paid for it. But you don't really care that much. Why? Because it brought you the good luck you wanted. It's serving its purpose. But you think you got your rhythm on gold because you've been watching it all year long. And you know what? You feel pretty good because your business, like I said, business is going well. Everything's going well. So you got a little bit of confidence, and you've been watching gold for a solid year now. So you decide you want to take some of that extra money you made this year and invest it in gold. So you call your broker on the phone and say, I'd like to buy some gold. Now that would be that you called a commodities broker on the phone. He says, well, in the futures market, you can buy gold, but gold is traded in 100 ounces of gold. So he said, the current price of gold is $1,250 in the futures market. And that's $125,000. He says, well, man, I don't have $125,000. He says, no, you don't have to give me $125,000. He says, if you give, we can trade gold on margin. So if you give me $1,000, I'll let you tie up that contract. He says, fine. Okay. Ties up that contract. The broker says to him, now remember, you've got 100 ounces of gold. If gold goes down $10, you're out of your pocket 10 times 1,000 or 10 times 100, and you're out of your pocket $1,000. If gold goes up $10, you make $1,000. He said, but I got to be whole at all times. So if gold dips down, you've got to either give me more money to cover it, or you could set a stop loss point and tell me where to close your position so you don't, get, bamboozled with gold, lose your shirt. He says, well, you know what? I think I can cover a $2,000 loss if gold moves against me. Broker says, fine. So I'll put a stop loss at 12:30. So if gold falls down to 12:30, we'll automatically close out your position so you don't lose any more than that. He says, now, where do you think gold's going to go? He says, based on all my calculations, gold should be going up this week. He says, okay, where do you think gold's going to go? He says, well, I think I'd like to see gold go up to about $1,300. He says, whoa, okay. Well, at $12.50 an ounce and you got 100 ounces, that means you'll make $5,000. He says, if you want, we can set up an automatic take profit point, and if gold touches $1,300, we'll automatically close out your position. He says, good deal. He says, all right, so we have a stop loss at 12:30 and a take profit point at 1,300. Now, you can call me and change those online, or you can go online or call me on the phone and change them anytime you want. He says, good. Okay. So he watches gold when he gets home from work every day for the next week. And on Tuesday, he says gold touched $1,300. He tells his wife they just made $5,000 extra dollars. You're going to go on vacation. He's all excited. He calls the broker and says, you close out my position, send me my $5,000. Broker says, what are you talking about, man? He says, you owe me $1,000. We closed out your position 2 days ago. He says, no, I've been watching gold. It hasn't fallen at all. It's been steadily going up all week. He said, in the Asian session on Friday night, Friday morning, gold fell down to about 12:20. He said, we closed you out at 12:30. He said, I don't understand this. He said, I looked every day and gold went up. He said, it has nothing to do with where gold was at the end of the day. It's where gold moved throughout the day. He says, man, this is a little bit too complicated for me. I didn't understand what my risk is. I don't know what the swing of the market is. I just know where I thought gold was going to go. He says, the broker says, you got yourself involved in something you shouldn't be, because you didn't understand all the ins and outs of how to trade gold in the futures market. So he gets, he says goodbye to the broker, says, close out my account, put the other $1,000 on my credit card, we'll call it even. He has to go home and tell the wife now. That's his worries. So he stops at the pub on his way home and has a drink. He's telling his buddy the story. Buddy's laughing. He says, man, you know what? You had more risk involved in that asset than you had for the purchase of your house. Your house isn't worth $125,000. He says, you should have started out with binary options. Binary options, you only have to guess whether the asset will go up or down. He says, maybe you're right. So as you can see, it's the same asset, same movement, just different risk and profit potentials. Now, we throw in a third complication, and that's CFDs. CFDs are contract for difference. You could have traded, instead of the futures market, traded gold in a CFD, which would have allowed him to take that same $1,000 and leverage it up, and he wouldn't have been buying 100 ounces. He could have bought as little or as much as he wanted, and he would have been making the difference in the contract value. But it still would have been moving in the same, based on the same underlying value. Now, basically, it's really all about risk. Finally, it cannot be stressed enough that trading in the financial markets carries a high level of risk and may not be suitable for everyone. Before deciding to trade foreign exchange, you should consider your investment objectives, levels of experience, and risk appetite. Remember, you could sustain a loss of all your initial investment, which means you should not invest with money you cannot afford to lose. If you have any doubts, we recommend you seek advice from an independent financial advisor. Now, let's take a look at all your other choices. Because binary options is just a simplified way of entering the markets because it gives you some experience to understand how the markets move up or down because it's all the same underlying asset. After that, when you kind of understand which way the markets move and why gold does this and why the dollar does that and why silver does that when gold is doing this and why oil reacts to that, okay, you can then come over or trade where the markets get very complicated. They're only complicated because you have to understand the swing of the marketplace, where to put your stop loss, your take profit point, because when you have huge risk and you're using leverage or margin and you're investing a lot of money in the markets, okay, you should understand what you're doing. So don't be intimidated or confused by terminology that seems to have nothing to do with the assets themselves, like spot, CFDs, and futures. What you really need to know first is what asset is underneath it. So whether you're trading spot gold or you're trading, a CFD for gold or you're trading gold futures, it's still moving with the underlying value of the underlying asset. For example, you might want to buy gold. You could buy spot gold. That's the price at which you would be the same as the physical asset itself. You could buy gold in a CFD or gold futures, but the price fluctuations are likely to be extremely similar because they all move in relationship to the underlying value of gold. The debate about CFDs and Forex versus futures is really a waste of time and not worth worrying about. Too many people get lost in these terminologies and what they want to trade. And what they should be concerned is how you properly trade an asset under that class, how you properly protect yourself, and how you properly make the decision whether the asset will go up or down. Spot and CFDs are essentially the same thing at this level because unless you're investing huge amounts of money, and we're talking about huge amounts of money, you don't need to worry about underlying interest rates. You don't need to worry about commissions and costs because whether you're trading in the spot market, you're trading in CFD, you're trading in futures market, they're all going to calculate out to fairly close to the same thing. One might charge you a commission where others charging you a spread, okay? But it really doesn't make a difference if you're investing a couple $1,000s. What you should be concerned about is understanding the underlying asset. The difference in the price movement should only occur when a CFD has leveraged itself, which is not very common. Futures are a little different as they can be less liquid and their prices influenced more by market forecasts. The important thing is that you check how much each instrument costs you to trade. When it comes to Forex versus futures versus CFDs, you will almost certainly find like the major spot Forex pairs are the cheapest to trade. So will gold and oil. The more common the asset is, the more likely, and the more it is traded, the more likely the costs will be less. So if you're going over to exotics, be careful because your costs could really tie up a good deal of your profits. It is likely that the more unusual the instrument, as a rule, the more expensive it will be for you to trade. CFDs will probably be more expensive than spot Forex. And in turn, ETFs will probably be more expensive than most CFDs. Unfortunately, the cost does not end there. Forex brokers also charge extra to hold most of these trades overnight. But very often they do not advertise these charges explicitly on their website because they're understood. And they almost all charge the same exact minuscule interest rate because it doesn't really have any value or it's so minimal that it doesn't have any effect on your profit or your losses. It does have a cost to you, but it's a minimal cost. If so, and all the brokers will let you know exactly what it is. Okay, there's no secret about the stuff. If so, contact them and they'll be happy to tell you what the current rates currently are. Make the calculation again. If you then have a table of all the assets you consider trading with the percentage costs that you will pay per trade and per overnight, keep these costs in mind. It's important that each trader evaluate the risks involved in each style of trading and understand the differences in the potential traps and errors. Do not trade what you do not understand. Now, basically, the most popular and the most of us, including myself, should be trading CFDs. They're the easiest, the least unfretted, and the least complicated of them all to trade. The difference between the trade is the entered and exit is the contract for difference. A CFD is a tradable instrument that mirrors the movement of the asset underlying it. It allows for profits or losses to be realized when the underlying asset moves in relationship to the position taken. But the actual underlying asset is never owned. You're not buying an asset. So you're not like buying the gold at the coin dealer. You're simply making a contract based on the value. Essentially, it's a contract between the client and the broker. And understand this. It is a contract between the client and a broker. It is not an exchange traded item. It is a regulated item. Okay. And therefore, you need to rely on the dependability of your broker. So that's why you should always be trading with a regulated provider and a broker that is reputable. Trading CFDs have several major advantages, and these increase the popularity of the instruments over the last few years. Now, lately, we have seen CFDs in the headlines a lot because they are regulated, and the regulatory agencies all over Europe have been cutting back the leverage available in CFDs. They're not cutting out CFDs. There's no problems. It was the leverage because too many people were going in and trading with 400 to 1 leverage and losing their shirt because they just didn't understand, or they thought, I can open an account with $1,000 and trade $40,000 or $400,000, and they were losing their shirts. When this is just stupid. So the regulators all across Europe have come out and limited leverage. In fact, the FCA is limiting leverage to 25 to 1 for new investors and 50 to 1, or this is what they put on the table, 50 to 1 for experienced investors. This is more than enough leverage. Warren Buffett once said, leverage is like a drug. It's good to use now and then, but once you've had a taste of it, you become addicted. And that's exactly what happens. Okay. CFDs are undoubtedly one of the most widely traded financial instruments in the UK, as well as the European markets, growing in popularity as traders around the globe become more familiar with what they are and how they can be utilized in their broader trading portfolio. Traded predominantly off exchange. This means through a broker rather than a stock exchange. CFDs provide completely inbuilt leverage for traders looking to ramp up their earnings and utilize a considerably more flexible tool for investing on the power and weakness of long-term assets and index performance. This is one of the major differences between CFDs and Forex. The abbreviation for CFD stands for Contract for Difference. This implies the position are effectively contracts with the broker instead of the sole acquisition of an asset. This is the key in terms, and this is very important, and I'm not going to tell you what it is because I can't. Period, the end. Okay. Everybody has their own tax scenario, but the key in terms of where tax treatments are of CFDs concerned and gives rise to a number of fundamental features that make CFDs unique. So you have to check, but in most places, CFDs are not taxable. Okay. But this is depending on what country you're trading in, what your own tax scenario is, but you should check them out because it's one of the advantages of trading CFDs. CFDs provide much higher leverage than traditional trading. Standard leverage in the CFD market begins as low as 2% margin requirement, depending on the underlying asset. For shares, for example, margin requirements may go up to 20%. Lower margin requirements, less capital outlay for the trader or the investor, and greater potential returns. However, increased leverage can also magnify losses. While CFDs appear attractive, they also present some pitfalls. For one, having to pay the spread on entry and exits eliminates potentials of profits for small moves. So in other words, in CFDs, the asset could move in your favor, but it moves a very small amount. Your cost through the spread, because you pay the spread to buy and you pay the spread to sell, can eat up some of your profits. So you don't want to go into a CFD if you're only looking for a few pips movement. The spread will also decrease winning trades by a small amount over the actual stock or the asset, and will increase losses by a small amount, but they're insignificant. So while stocks expose the traders to fees, more regulation, commissions, and higher capital requirements, the CFD market has its own way of trimming traders' profits by larger spreads. Because remember, any way you look at it, the broker has to make money. Okay. So sometimes it's in commissions, sometimes it's in interest rates, sometimes it's in spreads. It's all above board. There's nothing underhanded about it. But remember, any type of trade has costs involved in that trade. Getting to grips with the nuances and the pros and cons of different trading instruments is essential to building a solid portfolio. And while futures and CFD trading do not bear a number of notable similarities, it's important to remember they are fundamentally different products with fundamentally different characteristics which may lend themselves more closely to specific trading scenarios. Futures, as opposed to CFDs, are exchange-traded derivatives that bind a trader into buying or selling underlying assets at a specific price at a specific future date, hence the word futures. Now, what you have to remember is a CFD is not designed to be held for a long time, but you can hold it overnight and continue holding it till the market moves in your direction. A future has an expiry date on it, and in a future trade, you are fighting a time base that's also having an effect on the value of your asset. Okay. They work in much the same way as contracts for difference because traders take a position on future prices based on today's price point. If the price rises in the future, the futures will rise, and so the instrument can be resold or executed on the expiry date in order to reap the maximum reward. Futures are complicated somewhat by the rigidity they introduce into the equation. Expiry dates, set quantities, stricter rules of enforcement as compared to CFDs. Okay. Now CFDs, because they're a non-exchange product, they are through your broker, which means that they have greater liquidity and faster execution. Okay. So sometimes when a market is cascading or and you can't get out of an asset, if you have a CFD with a broker, you have no problem closing it. If you have a CFD and a futures market, it's got to be closed by the exchange, and when the markets are moving fast, you might not be able to close it at a price in which you wish to close it quickly. There are some other considerations when choosing between CFDs and futures. As mentioned above, they both leverage your money, which in practice means that you are charged interest by your broker. However, while with CFDs, the interest is charged on a daily basis, with futures, the charge is priced into the asset. As stated, the competition for your business should ensure that the rates charged is reasonable, but this is something you do need to check. As CFDs are typically a trading vehicle and you don't buy them to hold for a long time, the interest is usually not high enough to be a problem. But they do give you a choice to hold them for a little longer if you need the price to swing in your way. And when you trade futures, you may not have that luxury of enough time for this to happen. Then the third part we have the Forex, the foreign exchange market. And it is arguably the largest market in the world. Today, it's about $7 trillion a day. It was $4 trillion, and it was climbing over the years. What the stock market is about $1 billion a day. Okay, so it has huge amounts of liquidity. Forex traders buy and sell various currencies 24 hours a day, 6 days a week. The Forex market is global, but it's a fully decentralized market and an over-the-counter financial market for trading currencies. There is no Forex Exchange. It is a set of computers around the globe, okay, but there is no exchange. but it is extremely accurate, it is extremely liquid, and it's extremely reliable. Being worldwide is a crucial element of Forex due to the fact that traders are looking at different values between international currencies. Global and political events drive those markets and affect the relative values of different currencies. That in turn changes the value of the related currency. The Forex market is entirely decentralized, i.e. there is no centralized exchange, unlike the stock market, for example. Instead, financial centers around the globe function as anchors of trading between a broad range of various types of buyers and sellers around the clock. But the Forex market is highly regulated. You can be safe and comfortable trading in the Forex market. Daily currency fluctuations are usually very small. This is what most people don't understand. They think the currency market moves, has huge volatility. The euro is trading about 108 something today. If the euro drops to 108.10 from 108.20, that's a significant move, but it's 4 decimal points over to the right. So in other words, if you had 1,000 euros and it moved that much, it would have affected you 20 cents. Okay. Now, because people use huge amounts of leverage and margin and ramp up their trading, this is where they can get affected. But again, we're seeing all of this recalculated now. But this makes the foreign exchange market one of the least volatile markets around. Therefore, many currency speculators rely on the ability of enormous leverage to increase the value of the potential movements in the retail forex market. Leverage can be as much as 250 to 1. High leverage can be extremely risky, but because of the round-the-clock trading and deep liquidity, foreign exchange brokers have been able to make high leverage an industry standard in order to make the movement meaningful to currency traders. Why would you want to trade a currency that moves a couple pips a day? You only have a couple dollars in cash in your account. You work all day to do your analysis for a possible $25 profit. No, you want to ramp up your trading because the trading is small increments. But finally, it cannot be stressed enough that trading foreign exchange on margin carries a high level of risk and may not be suitable for everyone. Before deciding to trade foreign exchange, you should consider your investment objectives, level of experience, and risk appetite. Remember, you could sustain a loss of some or all of your initial investment. So let's begin our explanation of CFD versus Forex and similarities. There are a number of similarities of CFDs and Forex. First of all, both instruments involve a similar trade execution process. In other words, they're traded on the same platform, you follow the same steps. Traders can effortlessly enter and exit the market in both falling and rising markets. Secondly, both CFD and Forex trades are performed on identical platforms, exploiting similar looking charts. Same strategy, pricing approaches. Trades are performed in the over-the-counter market in both cases. This market is completely electronic within a network of banks with no central exchange or physical exchange. Another similarity to note between Forex and CFD trading is that the only trading cost is spreads. The difference between the buy and the sell cost, as opposed to other kinds of trading instruments that charge commissions as well as other financing fees. One of the major similarities between CFD trading and Forex trading is neither allows the trader actual ownership of the underlying asset. For instance, when one purchases the euro-Australian dollar, one is not really purchasing euros and selling Australian dollar, rather than merely speculating on the exchange rate. Similarly, when a particular trader buys a CFD contract for the FTSE 100, this trade is not in fact owning the stocks in the FTSE 100. Rather, they are speculating on the underlying price. Put it simple, Forex is just another type of CFD. Now, in the UK, a lot of firms offer something called spread betting, which is basically CFDs. So spread betting simply allows you to speculate on whether the price of an asset will rise or fall. You can gamble on everything from shares to commodities in the stock market industries and house prices. The thing is, spread betting allows you to trade or bet on just about everything, not just the financial markets. The beauty is that you don't actually buy the underlying asset you want to trade. You just take a view on the prices offered by the spread betting provider as whether the price will rise or fall. So remember, risk reward is the engine of money management. Okay. You should be always concerned and understanding how the trade is executed and what the risk is involved in the trade. A smart trader spends less time looking at his profit and more time looking at his risk. Okay. And when you exercise excellent risk management, you will find you'll stay in the markets longer and be able to turn into profits, because risk management and money management are the ultimate importance, and it's the ultimate difference between the types of trading you're making. It's how much you have to cover, what the spreads in the marketplace, what your costs are, as opposed to your profit potential. But risk and money management are the key factors in any type of trade you're going to make. So I'd like to welcome you into the ETX family. Thank you for joining us tonight. And please join us on Tuesdays and Sundays to learn all about how to apply proper strategies and make smart trading decisions. And again, on the ETX platform, you can try one of these or all of these. You can trade whatever you like. Just make sure you understand the risk involved in each type of trade. Thank you very much and have a great trading week. Good night now.